Pfizer, PFE, is one of the strongest stocks in the market right now, with the stock up 5.87% on the day yesterday. The technical opinion rating is a 100% buy and ranks in the top 1% of all short-term signal directions. Long-term indicators fully support a continuation of the trend. However, the market is approaching overbought territory. Be watchful of a trend reversal. Pfizer Incorporated is a research-based, global pharmaceutical company that discovers, develops, manufactures, and markets medicines for humans and animals. The company's diversified global healthcare portfolio includes human and animal biologic and small molecule medicines and vaccines, as well as nutritional products and consumer healthcare products. Pfizer's Animal Health business unit discovers, develops, and sells products for the prevention and treatment of diseases in livestock and companion animals. It sells its products to wholesalers, distributors, retailers, hospitals, clinics, government agencies, pharmacies, individual provider offices, veterinarians, livestock producers, and grocery and convenience stores. Pfizer Incorporated is headquartered in New York. Rather than just buying the stock, investors can use the options market to find smart ways to trade Pfizer stock with an attractive risk-to-reward ratio. Implied volatility is high at around 36%. The 12-month low for implied volatility is 16% and the 12-month high is 41%. The 4th percentile is 95%. That means it could be a great time to be a seller of options on PFE. That, coupled with the potential bullish action, makes it a great candidate for a bull-put spread. Today, we're going to look at a couple of bull-put spread trades with different expiration dates. Bull-put spread 1, February 55 to 50 bull-put spread. As a reminder, a bull-put spread is a defined risk option strategy that profits if the stock closes above the short strike at expiry. To execute a bull-put spread, an investor would sell an out-of-the-money put and then but a further out-of-the-money put. Let's use the first line item as an example. This bull-put spread trade involves selling the February expiry 55 strike put and buying the 50 strike put. Selling this spread results in a credit of around $1.13 or $113 per contract. That is also the maximum possible gain on the trade. The maximum potential loss can be calculated by taking the spread width, less the premium received, and multiplying by 100. That give us 5 to 1.13 x 100 equals $387. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 29.2%. The probability of the trade being successful is 79%, although this is just an estimate. The spread will achieve the maximum profit if PFE closes above 55 on February 18, in which case the entire spread would expire worthless, allowing the premium seller to keep the $113 option premium. The maximum loss will occur if PFE closes below 50 on February 18, which would see the premium seller lose $387 on the trade. The break-even point for the bull-put spread is 53.87, which is calculated as 55 less the $1.13 option premium per contract. Bull-put spread 2, January 55 to 50 bull-put spread. Let's take the 8th line item as our next example. This bull-put spread trade involves selling the same strikes, but using the January expiration. Selling this spread results in a credit of around $73 or $73 per contract. That is also the maximum possible gain on the trade. The maximum potential loss can be calculated by taking the spread width, less the premium received, and multiplying by 100. That give us 5 to 0.73 x 100 equals $427. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 17.1%. However, we achieve this return in only 1 month rather than 2. The probability of the trade being successful is 83.6%. The spread will achieve the maximum profit if PFE closes above 55 on January 21, in which case the entire spread would expire worthless, allowing the premium seller to keep the $73 option premium. The maximum loss will occur if PFE closes below 50 on January 21, which would see the premium seller lose $427 on the trade. The break-even point for the bull put spread is 54.27, which is calculated as 55 less the 73 cents option premium per contract. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull put spread, setting a stop loss of 25% of maximum risk is a good idea. In the first PFE example above, that would be a loss of around $96. For the second example, the stop loss would be around $107.